Good afternoon and welcome to another Merit Moment. For those of you who haven't met me, I'm JB Howard, owner of Merit Advisors. My team and I spend our days helping clients build wealth, protect wealth, and plan for predictable retirement income. Along the way, we help reduce expenses in the form of unnecessary taxation, interest to institutions, and things like overpaying for college. In short, we help clients avoid unintended consequences due to not knowing the rules of wealth building and the retirement income game.
Merit Advisors, helping improve lives by making ideal choices.
To get started, you need to understand what this rule is and why it matters. According to Investopedia, financial advisor William Bengen conducted an exhaustive study of historical returns back in 1994, focusing heavily on the severe market downturns of the 1930s and early 1970s. Bengen concluded that even during untenable markets, no historical case existed in which a 4% annual withdrawal exhausted a portfolio in less than 33 years. What that means is that once upon a time, back in 1994, 30 years ago, if you can believe it by now, time flies, there was a financial advisor who wanted to do a better job of helping his clients spend their retirement funds, but still allowing these funds to last a full lifetime. Now, clearly a notable and noble goal. In order to accomplish this goal, the advisor, Bengen, again, did an exhaustive study on various annual withdrawal percentages. Through that research, he discovered that as long as people didn't withdraw more than 4% of their portfolio each year, they could live off of that for as many as 33 years. So think about it. If you're retiring at 65, that means you'd have retirement funds until you're 98. And that was plenty long enough for most investors. And I still say it is. We talk in terms of 20 to 25 years for most families in retirement. But the issue is this overview or broad brush doesn't give us the full picture, okay? Was the 4% rule or was the 4% amount enough for each client to live comfortably, first and foremost? And did they have other savings vehicles outside of these stocks and bonds? There's also the reality regarding the makeup or the asset allocation of the investments Bengen was studying. As Rob Williams and Krish Kawashima explain in their article about the 4% rule for Schwab.com, the rule applies to a hypothetical portfolio with 50% in stocks and 50% in bonds. Our actual portfolio composition certainly can differ from that, and you may change your investments over time during your actual retirement. This is imperative. This is key to understanding this concept. The 4% rule was created from hypothetical portfolios, 50% stock and 50% bonds. The fact is important to really understand because everyone has portfolios that look extremely different. Not everyone will have that same 50-50 stock versus bond portfolio moving into retirement. Now, clearly, having a rule of thumb to follow, really, in order to know how much to withdraw from your retirement accounts and have them last for 30 years is helpful. I'm sure many people follow the 4% rule and have their retirement savings last their whole lifetime. But what about now? What about today? Things feel different, right? Where do we stand in 2021? In November of 2020, Brett Arends published an article after a conversation with William Bengen, again, who created the 4% rule. He writes, there's plenty of unknowns, both known unknowns and unknown unknowns. We don't know if the Fed can prevent deflation, let alone get prices even higher. We don't know what COVID's going to do to long-term returns. We also don't know, for example, whether inflation-protected TIPS bonds would work better than regular government bonds or treasuries. Although TIPS are designed to adjust their prices to the consumer price index, they weren't around in the 1970s. So we really don't know exactly what those would have done or how they would have functioned. He goes on to quote Bengen. While discussing the 4% rule, it's just not a law of nature, he says. It's empirical. In other words, or translated, based only on the data we've got, going back to the 1920s, one size just doesn't fit all. So the man who created the 4% rule has been quoting as saying it's empirical. But what's that mean? It means it's not a hard and fast law. It means that it's based on observation. When something's based on observation, it's subject to change given a different type of circumstances, because financial planning is all about planning for an uncertain future. And this is the only type of law that we're going to get in our field. I'm not saying Bengen came up with is unhelpful. I'm grateful for minds like his, but I'm saying it's not necessarily complete. It's not the whole story. If you've watched any of our Merit Moments in the past or read any of our blogs, you know that we tend to encourage people to move away from using these rule of thumb suggestions, because even the most well-researched rule, so to speak, is based on a certain type of portfolio or a certain type of market performance or even condition. Rigidly or blindly following these rules can lead people to run out of money prematurely or not utilize the entirety of their savings, being too conservative. Retirement's supposed to be fun. It's supposed to be exciting, and even adventurous for some. It's meant to be enjoyed. These are your years to live in financial peace, not to find out too late you followed the wrong advice. That's the major reason we try to make it clear that the 4% rule doesn't necessarily fit every single investor. So if the 4% rule can't guarantee longevity in your portfolio and comfortable income for you during retirement, what do we recommend? What we at Merit have found that over the years is that if you have a steady stream of income to supply your retirement needs, the needs, the requirements, you'll be in a place where you can utilize your stock portfolio or your investment, so to speak, to take more risk, as well as build for your legacy. Really, those become more of the wants. But don't take my word for it. This is a trusted source. Wade Pfau, who earned his PhD at Princeton, where he wrote his thesis on Social Security, states, retirees who wanted to front load their retirements and spend a lot of money in the early years would be better off with annuities, for example, while those focused on growing their wealth and having more assets in their later years are going to be better off with equities. But at the same time, he speaks out of the other side of his mouth, okay? People concerned about outliving their money might find an annuity attractive. Strange paradox, as you can see there. If you want a deeper dive into annuities, understanding Pfau a little bit better, take a moment to watch, go back in time and watch our Merit Moment number 8 about protected income streams, if you would. Really, to make a long conversation short, everyone's different. Every situation is different. There's volatility to consider. There's inflation that completely changes the conversation, and desired income is just different for everyone. We have different lifestyles across the board. These factors make the 4% rule an absolute challenge. It's truly just a base level suggestion that's been used without any planning to gauge whether or not someone really can just afford to retire. It's kind of a quick and dirty judgment. The outcomes of this can be disastrous if you make a decision without the proper tools, the proper planning. We just don't want to see anyone make that mistake. If you need some help discerning whether or not you can afford to retire, how much you can afford to enjoy in an income or a lifestyle in retirement, please reach out. We help people answer these questions every day. It's really a starting point for all of our new clients and even our existing clients. It's important you understand your specific situation and don't set up your plan based on a general rule of thumb, as we're talking about today. So your future doesn't have to be a complete guessing game. Bingen was an advisor who wanted to help his clients, and he came up with a way to help in 1994. 30 plus years ago. And we're studying the evidence today, and we'll guide you in the right direction, constantly making revisions and updates as things change. If you have a question about what we've discussed today, or you'd like to speak personally about your situation, please use the form below and send me a message.